Alright, so now let's continue Chapter 15, which is still the introduction for managerial accounting. And here we're going to compare between prime cost and conversion cost. So what are the expenses or expenditures that are considered to be prime cost? So any kind of direct material expenditures or direct labor expenditure, in other words cost, are considered to be prime cost. Why these are considered to be prime cost? Because they are the main cost that would put together this product. So like things like if we're thinking again about table, the wood used in building the table or putting together a table is considered to be direct material, and that's part of the prime cost. All the labor that was involved in putting the table together, sanding it and painting it, all of that is considered to be part of the prime cost. On the other side we have the conversion cost, and that's the cost related to converting the material into a product. And that includes the direct labor and the factory overhead. Because without the direct labor and the factory overhead, these raw material cannot be converted into a final product. So you can see here that direct labor is common between prime cost and conversion cost. So it can be could be considered prime cost, and at the same time can be considered conversion cost. But for direct material, it's always a prime cost. And for a factory overhead, that's always a conversion cost. So let's see some examples of product cost and period cost. And that's another thing that we have to pay attention to. What's the difference between a product cost and a period cost? So product costs, or the manufacturing costs, these are the costs related to the product, to putting together the product. The period cost, it's related to the time frame, and it's going to be paid anyway, whether we produce or not. So the product cost, we have here the direct material. An example would be the wood used in the neck and body of the guitar, because remember, we're using this Legend guitar manufacturing company. So the wood used in the neck and the body of the guitar, that's considered to be part of the product cost. That's the direct material used. The direct labor, so things like wages of saw operators or wages of employees who assemble the guitar, that's considered to be a product cost. Also, all the factory overhead, things like wages of janitor, power to run the machine, depreciation expense for the factory, the sandpaper and the buffing materials, oil used to lubricate machines, the salary of production supervisors. These are all product cost. Then we have on the other side the period costs. These are costs that are related to again the period, the time frame where this is going to happen. So things that are not really directly tied to the product. So we have here the selling and administrative expenses, and these are considered to be period cost. So one more time, all the costs or payments for the purpose of generating revenues, that's part of what we need to consider in any business. A product cost is the cost that we just covered. It goes directly to the inventory, and that would be presented on the balance sheet, and I hope you remember that. Inventory is one of the assets that are presented on the balance sheet. And then once it's sold, it goes to the income statement, and we call that the cost of goods sold. The period costs, these are the items or the costs that are not going to be tied to the product. So selling and administrative expenses, these also go directly to the income statement. We never show them on the balance sheet. So let's see here again another knowledge check activity, and here we're asking which of the following would be considered a period cost. Okay, not a product cost. Is it the sales manager's salary? Is it the factory supervisor's salary? Is it the heating cost in the factory? Is it the rent on the manufacturing facility? And I think it's very important now to pay attention to this, because direct versus indirect cost is different from period and product cost. The product cost is anything related to the product itself, can be tied to the product. So things like the factory supervisor, the heating cost, the rent on the manufacturing, that's all related to the product or the production. But the sales manager's salary, that's something that's considered to be administrative. So in this case, that would be our period cost. So again, one more time, just to make sure that why sales manager's salary is considered to be a period cost, it falls under the idea that any cost that is incurred in the factory or manufacturing process, that would be a product cost. How about period cost? The sales manager's salary would be an administrative cost, which is considered to be a period cost. So for a product cost, it has to be something related to the factory, the manufacturing process. But anything related to sales or not cannot be directly related to the factory or manufacturing, then that would be a period cost. Now let's talk about the financial statements for a manufacturing business. And this would be a good refresher for our knowledge for the manufacturing businesses. And I hope you can still refresh your memory with these with the income statements and the financial statements. So the statement of stockholders' equity and the statement of cash flows for manufacturing businesses are very similar to services and retail businesses. There are no differences. And I know in financial accounting we focus mainly on service and retail businesses. But in managerial accounting, we're going to focus or extend that focus to managerial or to manufacturing businesses. So when we talk about the balance sheet and the income statement for manufacturing businesses, things would be different. Because for manufacturing businesses, the balance sheet and the income statement will be more detailed. I don't want to use the word complex as it's mentioned here, but it's more detailed. So why is that? It's because manufacturing makes the product that it sells and therefore must record and report the product cost. So the reporting of product cost primarily affects the balance sheet and the income statement. So a manufacturing business reports three types of inventory on its balance sheet as follows. We have the material, we have something called work in process, and we have the finished goods. So these are three types of inventory. Unlike retail businesses, we only have finished goods because that's our simple inventory. In manufacturing businesses, there's material, which is the raw material used in the production. We have the work in process, which is a product that we started to manufacture, but it's not complete yet. It's still in process. And then we have the finished good inventory. That's the finished product or completed product. So as you can see on the balance sheet, the inventory would not just be a simple inventory. No, we have material, we have work in process. Sometimes they refer to it as work in progress inventory, which is the same. But I think for the sake of this textbook, we're going to use work in process. And we also have the finished good, which is the finalized item. This is the only thing that's very similar to retail businesses. It's the same level. So here we have an example for a retail business. It's called Musicland Stores Incorporated, the balance sheet for year 8. You see here that under current assets, they have the simple inventory item that we're used to in financial accounting. Not really different. And this is one of the assets that we present. It's typically one of the current assets. In our example that we've been using in this chapter, which is Legend Guitars, you see that inventory has been classified into three items. We have the materials, we have work in process, and we have the finished goods. And the total for these three numbers is presented as total inventory. By the way, these are not debit and credit. I just want to make sure that you're clear about this. On the balance sheet, we don't show debit or credit. This is just a sub-column calculation for the items in the inventory. So in inventory, you have three categories. We have the material, we have the work in process, and we have the finished goods. So let's see the income statement for a retail business versus manufacturing business. For a retail business, we used to have the beginning inventory. We show the net purchases, and when we add them together, that would give us what we call it inventory available for sale. Then remember, we deduct or subtract the end inventory to get the amount of cost of goods sold. When we subtract the cost of goods sold from our sales, we get the gross profit. So one more time, just to refresh your memory with the income statement. We usually start with sales or sales revenue. Then we have the beginning inventory. We add to it all the purchases. Remember, in retail, we don't manufacture anything, so we just buy the items and we sell it. So all the purchases are added to the beginning inventory that's remaining from the previous period. Then this would give us, the total of these two numbers would give us what we call it inventory available for sale. When we subtract from the available for sale items the ending inventory, so we subtract here the ending inventory, we get what we call it the cost of goods sold. So the cost of goods sold number is the difference between what's available for sale, and the ending inventory. That's what we actually sold. So think about it. We had 5 items. We purchased another 2 items. So we have 7 available for sale. We sold 4. Then the leftover would be 3. So, or we have leftover 3. Then we sold 4. So when we deduct the end inventory of 3 items, we get the cost of goods sold, which is 4. We subtract the cost of goods sold from the sales to get the gross profit. And this is what we've been doing in financial accounting course. In manufacturing, in this class, we're going to deal with it with slightly different titles. So we still have the sales as is. That's our sales. We have the beginning finished goods inventory, which is simply the beginning inventory, but it's the beginning finished goods inventory, which is finalized items. And then we're going to add to it the cost of goods manufactured during the period. And that will give us the cost of finished goods available for sale. Very similar to inventory available for sale, but we're only focusing here on the items that have been completed. Then we subtract the ending finished goods that have been sold, that has not been sold, to get the cost of goods sold. And that will give us the gross profit. So I hope that made it clear. Not much different. We just stress on the income statement that we are presenting finished goods. The raw material, the work in process are not going to be presented on the income statement in this case. So one more time, just to make sure that we get this topic. A retail business determines its cost of goods sold by first adding its net purchases for the period to its beginning inventory. Remember, that's how we get our available for sale. So this determines inventory available for sale during the period, and then the ending inventory is subtracted to determine the cost of goods sold. On the other end, a manufacturing business makes the product it sells using direct material, direct labor, and factory overhead. And that will give us the cost of goods manufactured. So the combination of these 3 items would be the cost of goods manufactured. We usually add the cost of goods manufactured to the beginning inventory to get the cost of goods manufactured or the finished goods available for sale. So the cost of goods manufactured is determined by preparing a statement of cost of goods manufactured. So let's see here. We have the income statement and we have the statement of cost manufactured. So let me start with the bottom statement here. We have the work in process at the very beginning. We add to it the direct material. And for direct material, we have to think about the beginning material we started with, the purchases of material, the cost of material available for use, and then we subtract the leftover of the raw material, the material inventory. And that will give us the cost of direct material used in production, the 130. So 65 plus 100 is 165, minus the ending inventory of raw material is 35. So that means that we used 130 in our manufacturing. So the cost of direct material used is 130. We add to it the direct labor, which is 110. And then we add the overhead. And overhead includes indirect labor. It includes things like depreciation, factory supplies. So we add all these together. That would give us the total overhead. So remember, in order to get the total manufacturing cost, we have to think about 3 things: material, labor, overhead. Material is the 130, labor is the 110, and the third thing is overhead. Very critical in management accounting. Material, labor, overhead. Remember these 3. So we have the 130, or the 110, the 44. The total would be the total manufacturing cost incurred in year 8, which is 284. Plus remember, we had some work in process from the beginning that was 30. So now the total manufacturing cost is 314. We still have leftover work in process, which is 24. So we subtract that from the 314 to get the cost of goods sold, which is 290. I know this might be a little confusing because we have 3 levels to calculate the cost of goods manufactured. But again, you can play it one more time just to see how this is structured. So once we have the 290, we're going to use that in the income statement. Remember, the income statement will start with sales. We have the finished goods inventory was 60. Then the cost of goods manufactured, we are going to get it from the statement of cost of goods manufactured, which is a separate statement. And that would give us the cost of finished goods available for sale, 350. We subtract from it the ending inventory or ending finished inventory, which is 62,500, would give us 287,500. That's the cost of goods sold. So 60 plus 290, 350, deduct the finished goods ending inventory, which is 62,500, would give us the cost of goods sold. Subtract the cost of goods sold from the sales, we get the gross profit. Then we have the other expenses like selling expenses, administrative expenses. Remember, these are period costs. And that would be 35,000. We'd subtract that from our gross profit to get the net income. So I hope that refreshes your memory a little bit with the income statement. I know it's a tough start that we're doing this from the very first chapter, but it's important material because we're going to be building on that in future chapters. And hopefully practicing would make this easier. Right, so now we want to see the flow of manufacturing costs, and I think it's good to know how the flow works, and I think it's simple, and if you can print out this sheet, I think it's going to be very helpful for you. So remember, the manufacturing cost falls into three categories. We have the material, we have labor, we have overhead. Material, labor, and overhead. So the material purchased, once it's purchased, it goes to our inventory, and it's going to be part of our inventory. So that's presented on the balance sheet. And remember, the balance sheet, we have three types of inventory. We have material, we have work in process, and we have the finished goods. So we have the raw material inventory, we have the work in process inventory, and we have the finished goods inventory. So the material purchase would go into the material inventory. Then the labor, the cost we incur for labor, can be either direct labor or indirect labor. If it's direct labor, it goes directly into the work in process because once we use the material and labor start working on it, that would be part of our work in process inventory. So see here this arrow that says direct material plus the direct labor would give us the work in process. It's not finalized yet. The indirect labor will go into manufacturing overhead. Overhead goes into manufacturing overhead right away. And again, that's also part of the calculation for the work in process. So three things that would impact the work in process. Direct labor, direct material, direct labor, and the manufacturing overhead. So these three things, material, labor, and overhead, are the main things that would start the production. Once these items are complete, they go into finished goods. We transform them into finished goods inventory. And once they're sold, they go into the cost of goods sold, and that's presented in the income statement. We never sell our material. The material is usually used for the production and until it reaches the finished goods inventory. Again, I hope this makes it clear. One more time. Let's see a knowledge check here. Which of the following is calculated for both a manufacturer and a retail business? Cost of goods manufactured. No, that's only for manufacturer. Ending work in process inventory. Again, once we see the word work in process, that means manufacturing until we reach final product. Cost of goods sold. Oh, that may be a common account that we see in manufacturing and retail businesses. How about ending raw material inventory? No, that's a manufacturing thing. So the correct answer is cost of goods sold. So both manufacturer and a retailer business would need to calculate their cost of goods sold to report on the income statement. Only a manufacturer would need to calculate the ending balance of raw material and work in process inventories, as well as create a statement of cost of goods manufactured. So the last thing in this chapter that we're going to go over is the analysis for decision making. And something that we're going to be going over today is utilization rates. So what is a utilization rate? It measures the use of a fixed asset in serving customers relative to the asset's capacity. A higher utilization rate is considered favorable, while a lower utilization rate is considered unfavorable. So the more we use our asset compared to its capacity, I think that's a good thing. So think about like a trucking company that have trucks, but they're not fully utilized. They don't use them on a regular basis, compared to another trucking company that the trucks are always running. Which one would be better? Of course, a business that has better utilization of their trucks, for example, would be better. Same thing, we're going to have an example here for hotel. So different service industries will have different names and computations used for measuring utilization rates. In the hotel industry, for example, utilization is measured by the occupancy rate, which is computed as follows. The guest nights compared to available room nights. And of course, we want to have more guest nights compared to what we have available. Because if we have a lot of availability and it's not fully utilized, then our occupancy rate is low. And hotels, they like to reach like 90% and above occupancy rate. So what is the guest nights again? It's the number of guests multiplied by the number of nights per visit, or the per time period. The available room nights would be the number of available rooms multiplied by number of nights per time period. So let's say for a month, it's like 30 days in a month. And that's how you see the available room nights. Some examples of service industries, services, and the companies, just to be aware of what we're talking about, especially for services. We have things like utilities. We have the electric power generation. A company example would be Consolidated Edison. Transportation, they usually provide overnight delivery, FedEx. Information would be something like a social media kind of service, Facebook and Twitter and some other things. Financial services, they provide banking, Bank of America, Chase, Wells Fargo. Education, higher education, I'll use here maybe University of Phoenix or maybe some other Chaffey College. Leisure and hospitality would be entertainment, Walt Disney or Disney Company. Health would be general health care, that's the service provided, so I'll use maybe Kaiser. Personal services, we have fitness clubs, something like Lifetime Fitness or Gold Gym or something like that. So all of these are good examples of service industries. So now let's see the managerial accounting differences between manufacturing and service companies. And here it's a long list, but I think we're going to finalize or end this chapter with this kind of comparison. So for manufacturing, for example, they use material, work in process, and finished good inventory. In services, they don't have a lot of inventory, and if they have it, it's only limited to supplies. Other thing is in manufacturing, they use both product and period cost. In services, they don't have a product, so they only use period cost. Also in manufacturing, they use cost of goods sold on the income statement. In services, they may use something called cost of services on the income statement. The manufacturing companies, they also require a physical production site. Many services require a network that connects the service to the customer. Examples include telecommunication, banking, power distribution, distributed entertainment, and transportation. And just speaking of the banking industry, many banking or many banks now, they don't have physical branches there. Everything is just over the internet. So even for a site, they don't need a production site or even a service site. The site is intangible site, which is a website. Also, if we go back to manufacturing overhead is an indirect cost in manufacturing products. In services, overhead is an indirect cost incurred in servicing or in serving the customer. For a manufacturing company, the labor is a direct cost to products. In service, it's a little bit more intense when it comes to labor. Labor is not a direct cost to product, but maybe a direct cost to customers. Examples are accountants in an accounting firm or doctors in a medical practice. You tie the labor to the customer, not a product. The manufacturing also, material are a direct cost to products. In services, material are often an indirect cost, but maybe as significant such as fuel for transportation or utilities. Think about like the bus services or airplanes, airlines. In other cases, materials are not significant such as financial, leisure, information, or education services. So I hope this gives you like a good introduction to managerial accounting and management accounting. I wish you all the best. Let me know if you have any questions, and I'll see you next week.